This video is sponsored by Skillshare. Go to skl.sh/theplainbagel6 to get a free 2-month premium trial. During market downturns like what we've seen with COVID-19, it's common to start seeing investors tout the benefits of certain safe haven investments. Assets, they argue, are uncorrelated to stocks. These investments, which include treasury bills, gold, and by some definitions, even Bitcoin, are argued by some to be recession-proof, the perfect asset to put your money into to avoid turmoil in the markets while still earning a return. The problem is that while certain safe haven investments do appear to be uncorrelated to stocks during normal times, during a market crash, the correlation between investments tends to increase, with stocks dragging other assets down with them. So, do these safe haven investments protect capital during a severe market crash? Well, with the recent COVID-19 bear market, it just so happens we have some recent data to help us put these claims to the test. So let's run the numbers and see how uncorrelated these assets truly are on today's Plain Bagel. In today's video, we're going to briefly go through several categories of safe haven investments and compare their performance from Wednesday, February 19th to Monday, March 23rd of this year to that of the S&P 500 over that same time period, which we'll use to represent the stock market as a whole. Obviously, this is a very narrow time frame, not to mention an incredibly unique one. First of all, a recession brought on by COVID-19 would be classified as an event-driven recession, which is just one type of recession we can experience. And as far as I'm aware, the 2020 bear market is the only one we've seen caused by a pandemic in the US. So let's be sure not to extrapolate this simple analysis to claim that these assets are bad investments, or that this even proves that they aren't safe havens. But one would expect that these investments would have insulated investors from the rapid 34% drop we saw in March. Otherwise, their downside protection may be blown out of proportion. So we'll take a look at the assets, see how they performed, and what their correlation to the S&P 500 was. A refresher that correlation is a measure of the interdependence of variables that ranges from -1 to +1. A perfect -1 correlation means that as one variable goes up, the other goes down. And a perfect +1 correlation means the two variables move together. In absolute terms, anything above 0.9 is considered a very strong correlation, 0.7 to 0.9 is considered strong, 0.5 to 0.7 moderate, 0.3 to 0.5 low, and below that, variables show no relationship, meaning they move independently of one another. When it comes to safe havens, we should expect to see measures close to 0 or in the negative range. So let's hop right into it with the first traditional safe haven, the government bond, or more specifically, the US Treasury bond. The US is viewed as the strongest economy in the world, so lending your money to the government is viewed as a safe haven investment because there's a high probability you'll get your money back. In fact, in financial theory, treasury bonds are considered risk-free because theoretically, if the US government didn't have the money they needed to pay you back, they could simply print more cash or tax their people to meet their obligations. Now, obviously this would not go without severe ramifications, and the independence of the Federal Reserve would make this strategy very difficult for the government to carry out. But regardless, the Treasury bill and bond are considered safe holdings for investors during times of turmoil. And indeed, if you look at their most recent performance during this recent crash, Treasuries do appear to have held their own. If you look at the Vanguard Treasury bond ETFs for short-term, intermediate, and long-term bonds, you can see they all increased by varying degrees during the crash, with longer-term bonds performing the best, something we expect to see since these instruments guarantee income over a longer period of time. This led to negative correlations to all three of the ETFs. Although while the short-term ETF had a strong negative correlation, the correlation for the longer-term ETF was fairly weak. So treasuries do seem to demonstrate some safe haven qualities, and because so many people flock to the security, treasury bonds earned a decent price return. But there are some important factors to consider here. First of all, treasury bonds see their prices rise when interest rates fall. And during this specific time series, the US Federal Reserve carried out a material rate cut that brought the federal funds rate effectively to 0%. So it's unclear how much of this price return is attributable to market uncertainty versus this rate cut. Secondly, unless you have a plan to trade these securities actively, their long-term return prospect isn't that great for you to hold on to maturity. You see, going into this downturn, treasuries were already paying very low yields to investors. And while prices have gone up for existing bondholders, meaning they can sell them at a profit, their yields have only gotten worse. In fact, if you look at the yield on 13-week treasury bills, which is one of the shorter maturity treasuries, it actually dipped into negative territory, meaning investors who bought them at that point in time were actually going to earn a negative return, getting back less from the government than they paid for the security. So while existing owners looking to sell benefit from the rising prices, new investors picking up these securities are unlikely to earn a return above inflation if they hold them to maturity. So treasury bonds did seem to protect investor capital during the recent crash. And indeed, many portfolio managers allocate segments of their client accounts to government bonds for their diversification and safe haven benefits. But in the long term, they currently aren't very profitable investments, although that might change in the future depending on where interest rates go. Next up, let's look at another traditional stock safe haven, which is other stocks. No, seriously, depending on their underlying business, some stocks are thought to be protected from downturns. These stocks generally include companies in the healthcare, utility, and consumer staple sectors. Because in contrast to sectors like consumer discretionary, which takes a hit during recessions, many investors expect these companies to continue seeing demand during recessions, given the essential nature of their business. After all, no matter how bad things get, people are still going to need food, electricity, and medicine. But looking at the numbers from March, that security didn't seem to stave investor fears. If you compare the performance of the S&P 500 healthcare, utility, and consumer staples indices to that of the broader S&P 500 over our time series, the returns were almost just as bad as the aggregate market. Now, this could be due to some event-specific factors. During a pandemic, there could be logistical obstacles preventing these companies from selling their products. Nonetheless, the sharp decline is a little surprising. Not to mention, these companies had near perfect correlations to the S&P 500. It goes to show that when markets see heightened volatility, stocks tend to move together at the aggregate level. So while some individual positions may do well in a downturn and earn a positive return, buying a sector as a whole for its safe haven properties doesn't seem to protect you from sharp declines. Next up, we have gold, which is really the poster boy of safe havens. Many people place their money in gold, believing that it not only isolates them from falling profits in the market, but also from the deteriorating value of currencies. Because when times get tough, central banks often carry out expansionary monetary policy that can cause severe inflation if not handled properly. This is something that would deteriorate the value of the US dollar. So gold is thought to remove that inflation risk while offering downside protection. But how did the precious metal perform during this recent bear market? Well, compared to stocks, it didn't do too poorly, but it was far from a perfect hedge. Gold prices on the COMEX future market fell by 2% over the time frame analyzed, and its correlation to stock prices was 0.63. It's a fairly low correlation, but still demonstrates a moderate positive relationship to the broader stock market. Now, obviously falling 2% is a lot better than falling 30%, and the metal did actually recover right after the crash. Not to mention, it jumped as record jobless claims were reported. So this doesn't really prove the metal doesn't provide any protection in a recession. Furthermore, in 2008, the price of the metal did actually appreciate as stock prices fell. So in the past, it has acted more as a safe haven during longer declines spanning financial crises. But during the recent market crash, gold fell with stocks and only recovered when stocks were exiting their initial downturn. So perhaps in this particular sort of downturn, gold is less effective as a safe haven. But given its small decline, it still scores fairly well for preserving capital. Finally, let's talk Bitcoin. Bitcoin has long been argued to be a form of safe haven because, like gold, it has a finite supply, meaning it isn't subject to interference from central banks like fiat currency is. The thing is, we haven't really been able to test how Bitcoin would perform during a bear market until now. And, well, honestly, it didn't do too well. Just like stocks, Bitcoin fell quite a bit over the time frame analyzed, seeing a drop of 29.5%. And its correlation to stocks was 0.91, a meaningfully strong correlation. So when it comes to market crashes, Bitcoin doesn't seem to offer any downside protection. Like other assets, investors and traders who hold them are prone to the same fears as those who invest in stocks. And while Bitcoin was argued to be gold 2.0 at its onset, the OG seems to have protected its throne in the COVID-19 downturn. So those are how safe havens performed during this year's market crash. Of course, this by no means is a comprehensive or even statistically significant analysis, but the point I'm trying to make here is that there's no silver bullet for avoiding these market crashes. Treasuries were really the only investment that performed better than you would have done just holding cash. And even there, we saw a huge interest rate cut fueling that return. In the end, market crashes are just part of what we sign up for when we invest. After all, risk is the counterpart to return. And while that doesn't mean we should take on unnecessary risk or ignore red flags, it does mean that in order to achieve return over time, we're going to occasionally see volatility. It sucks. But rather than trying to time the market or try to predict the uncontrollable factors, focus instead on what you can control. Take on risk that's appropriate to your risk tolerance, with consideration for any big purchases you might be making in the near future. Many investment professionals also recommend that investors diversify to reduce risk, both between stocks and across other asset classes, including some of the ones we've discussed. You can always seek out professional advice if you need guidance. Finally, keep in mind that over the long term, quality companies should recover as their operations return to normal. But as shown by our calculations, even some safe havens are subject to short-term volatility when we see a market crash. So, if someone tells you they have a recession or crash-proof investment, be skeptical. If a market downturn is causing a 30% drop in stocks, it's probably taking their ideas with it. Thanks for watching. If you like this video, make sure to like, subscribe, and hit the bell icon for notifications. If you have any feedback or topics you want me to cover in a future video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today. As you probably saw, a lot of the numbers I used in today's video were calculated using the Data Analysis Toolkit in Excel, which I've highlighted before is probably the single most important program to know in the world of finance. Problem is, it's not the easiest software to learn. Which is why if you're looking to develop your spreadsheet skills, I recommend you check out Microsoft Excel 2016 Bootcamp, Zero to Hero Training on Skillshare, the sponsor of today's video. Skillshare is a platform with a bunch of video tutorials on both professional and leisure skills. And this course in particular is really beginner friendly, touching on the basics and working up to things like pivot tables, a tool I use on a daily basis at work. But if Excel isn't your cup of tea, Skillshare has a huge library of other courses teaching everything from leadership skills to pottery to data analysis. So whether you want to pick something up for fun or to further develop professional skills in your downtime, there's a lot to learn from the platform. It's a service I personally really enjoy using. And at $10 a month, it's fairly affordable too. But in case you're wanting to try it before you buy it, you can visit skl.sh/theplainbagel6, link in the description below, to get a 2-month free trial. It will give you a chance to really explore Skillshare's offering, and clicking the link will support the channel by showing Skillshare that I sent you their way. So if you're wanting to try something new or really develop your capabilities, I recommend you check out Skillshare.